Hey everybody, Mike DeAndre here. Today is Friday, March 20th, and I wanted to take a minute to walk you through what we're seeing in the market. And it is, as always, very, very interesting. So, again, Mike DeAndre here, CMT, ChFC, my contact information down there on the right, and let's get going. So, these two guys have been doing a number on the market lately. Sometimes it feels like they fight against each other, and sometimes it feels like they conspire against us. And right now, feels like this type of market, they are working really hard to conspire against us. So the bulls and the bears, depending on your time frame, there's a little debate as to who is in control of this market, but one thing's for sure, there is really not a clear direction yet established. So with that in mind, let's take a look at the drawdown in the S&P from its recent highs. And those, I know saying recent highs feels like it's doesn't seem appropriate, but we did have a high in the market and it was 6.72% ago. So as we've said many times, 5% pullbacks, very common. You can experience them multiple times a year. You can experience them many times a cycle, but 5% pullbacks are just kind of part of the deal in investing in equities. Once you get between the 5 and 10, the temperature begins to rise a little bit, and that's kind of right where we are right now, almost right between a 5 and a 10% pullback. And then once you're kind of over that 10% threshold, there's some potentially serious damage that can be done. So we don't want to be cavalier. We don't want to just say, oh, the market always goes up and it always solves itself and everything's okay. And, well, I'll leave it at that. But we're in an area where this is a to be expected range of volatility from a drawdown standpoint. Now, everything else that's going on in the market that's contributing to this, I don't know that I would ever describe it as standard, or we have bombs flying, we have things going on, we have some changes geopolitically that we haven't seen in a while. And there could be some great things that come out of that, but they're to be determined. So hence we have some heightened volatility. So if we're going to take a step back and look at a broader picture of the market and look for how that volatility is manifesting itself. In other words, sometimes you can have price changes and price sort of solves itself over time, or it can solve itself by having a deep drawdown in the market. And right now it's feeling more like a time correction. And I know correction is such a subjective word, but put it this way, it's a time in which we've had a while since we've had a new high and things are just kind of chewing really hard sideways. So if we look here down at the NYSE new high low and the S&P new high low, we can see if we go back to April 2025, in that sort of liberation tariff announcement, we saw some serious selling in the marketplace, and it was confirmed with these orange bars reaching down below and showing us that we hadn't made new highs in a while, and there was some actual real selling going on in the marketplace. And then we have this strong move out of that drawdown, if you will, and we're kind of hanging in there in that range, but we don't want to assume that this is going to stay in this posture forever. If you see, we've got a few months before we had the big drawdown, we stopped making new highs. We stopped having those big, vigorous up days in the market and kind of seeing the same thing play out here. So we don't want to be complacent. We don't want to just put it on cruise control and ignore it here, because this is an important area. We're back into these, every time the market touches a certain level, and maybe we're coming back into that, what's that, around 21,200 in the NYSE. That's an important level apparently, and it tells us that based on this horizontal line and based on this anchor back to the bottom of Liberation Day. So with that in mind, let's look at some indices and how they're comprised, what they actually own inside of them, and then how the performance of today's market is sort of making sense with what we're seeing. So we have the S&P 500, and we're looking at its sector breakdown. So right now, the largest sector is information technology, which is down from low to mid 30s, if memory serves, not too far ago. Second position, we have healthcare, then consumer discretionary, communication services, financials, and then we get to sort of in the bottom half with industrial, staples, energy, materials, real estate, and utilities. And if we look at the performance over recent, what are we looking at here? We're looking at 3 months, and we can see the top half, all the heavy sectors in the S&P are negative. Some of them double digits, financials down 10.36. And this is actually as of yesterday's close. And Benchmark today is down almost 7, so that's a couple days, couple ugly days here in the market. But I for the purposes of this graphic, it still tells the same story, which is we kind of have the heavyweights in the market are getting it taken to them, and the lightweights in the market are the only place you see any performance, any value that to be made, and that's in your industrials, staples, and the big one here is energy, utilities, real estate, materials. This is the place to be, and if all of your investment exposure is coming from indices and sort of the big cap weighted type of thing, you're lagging pretty hard and probably having a little bit more stressful time than if you have the ability to rotate away from this. So even if we take a look at a few more indices and you say, well, I'm diversified because I own the S&P and I own the Qs and I own the Dow Jones and I own the equal weight. Most of you don't even know there is an equal weight, but that's okay. You'll still see that the strongest part of the market is still really, really underrepresented. In fact, the Qs have hardly any representation down here. Same with the Dow Jones. Equal weight S&P has a little bit more, but the areas of the market that are being rewarded, and this isn't even including any commodities aside from energy or precious metals or industrial metals, which are also on a maybe longer time frame. The last few weeks have been pretty tough, which we'll show in a second. But the cap in S&P cap weighted, NASDAQ 100 cap weighted, meaning the largest companies have the most votes, the largest representation in the index. Dow Jones is a price weighted index. The securities that have the largest price have the highest weight in the Dow Jones. Equal weight is, the corollary, or the example we often give is the S&P is the House of Representatives. The larger your state, the more representation you get. The largest your market cap, the more representation you get, and the equal weight is the Senate. Every stock gets 2 votes. Every state gets 2 votes, or 2 representatives. How they vote, who knows? But so regardless of how you diversify across the big, newsworthy indices, which you'll see, you turn on the television anytime, you'll see a crawl with these on there if you're in a news channel, they're all kind of have the same blind spots. So we need to figure out what are we going to do to avoid those blind spots in the indices. And we're going to go beyond just the normal menu of items. This is a slide that we could probably spend an hour on alone. Don't worry, I have no interest in doing that, and neither do you. But this is some relative rotation analysis. We're breaking the top 20 areas of the market that we look at into 4 quadrants. And so we have U.S. stocks, U.S. sectors, international stocks, commodities, and bonds, all broken down and represented in this. And the positions that are in the top right are our leading quadrants, bottom left are our lagging quadrants, and then things rotate through weakening into lagging, into improving, back into leading, and they sort of follow a circular path in some cases. Now, doesn't mean they have to. They can go from leading to weakening. Oh, man, I don't want to show that yet. That is my buddy, Jay Powell. But anyway, they can go from leading to weakening, back into leading, or from leading to improving, back and forth. But the point is not predicting where they're going to go, but observing where they're going to go and then tilting your assets towards those locations. So if we look down here in lagging, what do we see? We see technology, we see the financials, and we see consumer discretionary. Those are like your high flying, hey man, let's have a good time. The party's on, it's a bull market, woohoo. So if these areas aren't performing, it's your big cap weighted indices that have a lot of representation there are going to have a hard time. In case in point, you see the NASDAQ 100 right down here. And we're looking at the last 10 weeks of performance, both of them down around 6%, financials down 12, discretionaries are down 13. But if we hop into the right, we see energy, commodities, utilities, industrials, emerging markets. These are industrial metals, these are industrial stocks, consumer staples, materials, real estate, the international index, and the S&P total market. Weakening areas. Healthcare, if I pulled up the rotation graph itself, you'd see healthcare has really kind of been sort of a mess as of late. And precious metals have had some seriously large, dramatic moves. They're not going to get into it in this presentation, but we've taken profits twice in our precious metals positions over the last few weeks and rotated into some other things, but they are still in the right side of the graph, if you will. You want to be on the right side of this graph. And there is a potential that they could move back into weakening, or into leading, but so far they're still in weakening. Now, what's in our improving area? Well, things that we're really not all that excited about. I mean, communication services, that's fine, but the bond market isn't the place you want to see, that could be rotating into the leading quadrants soon. Okay, that's you typically would see those in the lagging area if you were in a really good strong market, or even in weakening, but not in improving or leading. So again, our friend Jay Powell here, observing, keeping an eye on the renovations over at the Federal Reserve. What are we keeping an eye on? So first thing we're keeping an eye on is credit spreads. Credit spreads help give us an idea as to what the market perceives the health of the market is. I know it sounds like a circular definition, but it's not. So when credit spreads begin to spike, we know that it's kind of confirmation that something really bad or dangerous could be going on in the marketplace. And if you look at the purple line, this is a rate of change, or rather it's measuring the change in the absolute chart above and giving us an idea of, kind of where are we in relation to the other moves. And the tariff 1.0 and the pandemic and the inflation scare and tariffs, they all kind of spiked pretty hard. And then we had the banking crisis, which really never got to the same position. And I labeled this Iran. Who knows? We might be calling this something else soon. But right now, I just called it Iran. And we see a pretty modest spike in credit spreads, but something to keep an eye on. We don't want to see this reverse into something much, not reverse, but continue into something much higher. Right now, it's kind of in that more modest, I don't want to call it a spike, but more modest increase. But we want to keep an eye on that. Next thing, software stocks. So software stocks are kind of a subsector, an industry group, if you will. And if we look at an area of interest in software stocks, we take the peak in the end of 21 and then anchor also a VWAP to that period of time. And you can see how the price just never was able to get above. And then it broke through, came back, retested from the top, and then was off to the races. But it still paused at this area of interest right around 6,026, 62, it's about 6,200 on this. It's a meaningless number, but because it's only relevant to this index. But this has definitely been an important number to the area because it keeps bouncing from that space. It's really important software stocks hold this. And I would not be a buyer here of software stocks just yet. We're looking for opportunities, make no doubt, but it has to prove that it is able to sustain itself and actually do what it's been doing, which is bounce through. On a relative basis, when you see this price line of software stocks dipping below this moving average, it tells you it's strongly outperforming the S&P, and it's not exactly a great candidate today to have owned, but there could be opportunities coming forward. So again, keeping an eye on it. Echoing the industry group, software stocks of the subsector, let's look at the big brother technology sector, and we see kind of a similar story. If we anchor back to the big tariff day, the big liberation announcement, and we look at sort of the last area of consolidation in technology stocks, this is on a weekly basis. We see a confluence of data. We see these two things coming together, and we'd say, man, this would be a really good time for things to make a reversal. Don't have any evidence that has taken place yet or that it will take place, but that's why, again, we're keeping an eye on it. Dollar index. Dollar index be great for our international stocks and our commodities and our precious metals for the US dollar to reverse back down and not create a new sort of bullish regime here in the dollar. This red and green line, this kind of represents an area of polarity. So the way the adage goes is what once was resistance, here, boom, now becomes an area of support. So now it's coming and testing from the top, boom, boom, and then it broke through again. Now we're underneath of this line again, and we'd like the dollar to stay underneath of this line. So again, keeping an eye on it. Another opportunity area in the market, and this one actually might be showing a little bit of sign of life. This is your high beta versus low vol, or your high volatility versus low volatility stocks. And if we're anchoring down to this gap, this if I pull this chart further left, it would kind of make the right-hand side a little harder to see. But what you'd see is that there's a strong area of interest back into the left of this. Then we had a little gap up into that. Since then, that anchored VWAP has been an important location for this price, this relationship to sort of come in and take the market's temperature. And it's done it 1, 2, 3 times. And now we've got a big consolidation taking place. And this is from Thursday, not from Friday. And we kind of broke above it. We've come back down and tested it once again. And I'm pretty sure we're still in between the orange and the blue line. It would be nice to get a definitive break to the upside, but a definitive break below the blue line is information nonetheless and would help us understand how to position our assets. So again, this isn't about saying, oh, the market has to go up. This is about saying, if the market isn't going up, what do we do? If the market is going up, what do we do? It's not about, cheering for an outcome. It's about responding to what actually is taking place. So the most important thing I'm really looking for is this guy, this little fella here who garners so much attention. It's an entire cottage industry. And of course, this is the Loch Ness Monster. And what does the Loch Ness Monster have to do with investing, Mike? It doesn't make any sense. But if you take a look at this commodities chart, the Loch Ness Monster has shown himself quite strongly here. We have this commodities breakout, and it's just this beautiful arching thing. Oh, there it is, right down here in the corner. There's our Loch Ness Monster, or ChFC if you're from the DMV. This explosion through an area of relative strength against the S&P is just a beautiful thing. And as you can see by the performance over here on the right, this long consolidation going back to 2022, then finally resulting in a massive gap and go that, who knows, this could continue for a while. Same thing taking place in the energy sector. There it is, the Loch Ness Monster breaking through that pattern here of pressure against the S&P. Beautiful follow through in that move in energy. And also in U.S. Defense Industry Index. This one has done it a few times and kind of did pretty well, hung in here, kind of moving with the S&P. But as the S&P has pulled back, this has not, and it's continued on. And so we like seeing that type of movement, that type of breakout in a relative strength chart or a ratio chart. Now, here's what we don't want to see, and that's the business end of a bull in a suit with their head buried in the sand. Okay, that's not very attractive. That's not very becoming. And here's a financials chart, and we see, boom, right there, burying its head right in the sand. And on an absolute basis, financials went up from here, but they didn't go up as well as the broad market did. So you can be an okay stock. The point, that's not really the point. The point is, where do we want to throw our assets? How do we want to invest our hard-earned funds? It's in places where we have the best opportunity to be rewarded. And understanding how we're doing against a benchmark is really an important piece here. And we don't want to just bury our head in the sand and kind of, go off in our way. We want to do things that are strong. So here's how we're responding to this market. This is what we're keeping an eye on. And, indices are wonderful. They're great, but there's more than 2 or 3 out there. And just owning the big ones because it's easy and it's sort of a default posture isn't a process. And it's certainly not the one that we're going to partake in. So if this seems to have been something that's helpful for you, or if you're a client with questions, feel free to reach out. Numbers on a bunch of these slides, and we'd be happy to chat with you. Take care. Bye.